What's up everybody? Welcome to the Stocks channel. My name is Corey and today we're going to do macro technical analysis and we'll be looking at weekly charts of all the indices, the VIX and Bitcoin. So first up, let's take a look at a weekly chart of the SPX S&P 500 index. So let's crack open this chart and see what's going on in the stock market today. Alright, so on a weekly chart of the SPX, you can see that we did get a weekly close on the price action below the 50 EMA. So that does mean we're starting to lose that support level at 4,300. Remember that the longer price action stays below 4,300 on SPX, it's more than likely that we're trending lower to the next support leg lower at 4158. Now 2 weeks ago we did test that level at 4158, but it was a weekly wick because the Bollinger Bands were not yet expanding enough for the price action to close at that level. You can now see the lower Bollinger Band is negatively sloping and these Bollinger Bands are starting to expand. So it's going to increase the probability we can see price action starting to walk down lower, which is going to significantly increase the probability we see price action closing near those lows. You can clearly see these moving averages are negatively sloping and the 50 weekly EMA is starting to flatten out. So the moving averages are starting to catch up to the price action and you're starting to see the momentum shifting for the bears. The bears have full control of this market and the bulls really don't have control on SPX until they can start closing back above 4,500. Back above 4,500, the bulls will be looking like they're coming back and they're going to try to make another push back to the previous all-time high. But until we see that price action, we need to continue to point our eyes lower. So watch these very critical support levels right around 4150, and if we break and close below that level on any given weekly close, we're more than likely going down to fill that gap, which is going to bring us down to SPX levels of 4,000. If we continue to capitulate and we go lower than that support level, we still do have significant support at our trend line right around 3,900. So right now you really need to respect the fact that the trend is lower and there's a lot of downward momentum. Even though we could get intraday bounces off of any of these support levels, especially on daily charts and daily analysis, you need to respect that overall the macro trend is starting to weaken and the bears still have full control of this market. So right now I would start thinking about the possibility that the month of March is going to be a continuation of the taper tantrum, and while there's plenty of reasons for the market to go lower, we know a lot of this has to do with the Fed tightening and liquidity is starting to dry up, as we do have other news and other things that could also drive the market lower. We follow the price action first and foremost, and it's very clear that the price action is showing a very weak market that wants to try to go lower. So if you're trying to get bullish, you need to see SPX getting back over this level right around 4350. But if you want to be more conservative to start taking long trades, you really need to wait until SPX is back above 4500. So in a macro level view, as an investor, you really shouldn't be too worried about trying to catch the bottom. So watch these critical support levels and just make sure you have some dry powder in the event that we do go down for those levels. Anytime you're buying as you go lower, you have to be completely fine with the possibility that the market continues to go lower and you didn't actually catch the bottom. But as a long-term investor, you really shouldn't be worried about catching the bottom because time is on your side, and we do know long periods of time, over 10 to 15 years, the market is typically much higher than where you bought. Now, as a trader, you need to be a lot more cautious because intraday swings and intraday volatility could easily stop you out of your positions, and you could really start to lose a lot of money in a volatile market. So watch these critical levels and make sure you're not getting bullish in a downtrend unless you're going to be a long-term investor and you don't mind holding that position. Jumping over to the bear bull survey, you can see that we did have a reduction in bears this week, going down from 53% down to 41%. We also did have an increase in bulls, going up to 30% from 23%, and overall we still have about 28% of the people that are neutral. So this is really a mixed bag, and that's what you would expect to see as the market goes lower, because there are going to be some bulls that see opportunity at strong support levels and they're getting more bullish the more the market falls. Be cautious doing that unless you're a long-term investor, because there is the possibility we reach full capitulation and we go much lower than you would expect. So until we at least hit SPX 4000, I wouldn't be getting overly bullish. And even then, you still need to be cautious because we still could be going another couple hundred points lower. So there's not too much to report on the bear bull survey. Even though we do know there was a lot of bearish sentiment, overall the market price action is speaking for itself. And until we get a strong bullish bounce off of one of these support levels and get a bullish breakout, I would still remain very cautious in this market. On a weekly chart of the NDX, you could see a very similar sign as the SPX with closing down below a very critical support level, and we did get another weekly close below 14,000. We do have our support trend line right around 13,600, and below that we're coming down to the next critical support level right around 13,300. These are very strong support levels, so if those levels do break down, you're looking for the next leg lower right around 12,640. So watch these very critical support levels, and you can very clearly see price actions below all of these moving averages, and all of these moving averages are negatively sloping. Remember, these are weekly charts here, so this is a macro level downward move, and we are coming into very strong support. So if these levels don't hold up, we're more than likely going to see the NDX going into a bear market this year. So you can clearly see weekly candlesticks are red for the first week of March. So you really need to be very cautious, and the possibility of March being another red month is very real. Now for the NDX to start looking more bullish, you need to see price action getting back above 14,557. And if we get above that level, there's going to be the possibility the bulls are taking back over control. And then we will want to see a weekly close at a new high, taking out the previous high right around 14,700. So watch those critical resistance levels to tell us the bulls could be making a comeback. But otherwise, you should be expecting lower prices because the price action and the trend are very clearly going lower. And you know price action is king. So watch the price action at any of these critical support levels, because that's going to be the first sign that the bulls are coming back if we do start to get a strong bounce. It's going to take a lot of damage repair to reverse the downward trend for the bulls. So you're going to learn the most by watching the price action in the next couple of weeks, because these critical levels and how price action behaves at those levels is going to tell you more information than following moving averages. It's very clear the moving averages want the market to go lower, and it's very clear there's a lot of downward momentum. So right now it's all about following the price action, and that's why we do our day-to-day analysis and watch those critical levels. Jumping over to the Dow Jones weekly chart, we can see more trouble in paradise for the bulls, because it now looks like we do have this confirmed double top look. We had a weekly close below this neckline at 34,000, so that does mean we could now see the Dow Jones starting to break down and going a full measured move lower. If we go down the full measured move from the neckline to the double top, that will more than likely have the Dow Jones trading all the way down around 31,600. So that's a lot more downside if this double top plays out. And just because we have a confirmed double top doesn't guarantee that we have to go lower. So you still need to follow the price action. Typically, if you see something like this, you want to pay close attention to it. So I wouldn't ignore the fact that the Dow Jones is starting to signal a lot more downside. And that does go hand in hand with what we're seeing in the rest of the markets. We're seeing strong downtrends and weak price action, and we do have lower confirmed price targets that we're more than likely going to reach. So don't get faked out in a bull trap if we start to bounce early in the week, because more than likely we're going to continue to see the market trending lower until we get confirmation of bullish breakouts. In the Dow Jones, your bullish breakout will be back above 34,157, and until we see price action getting above these critical levels, I would be very cautious of more downside and try not to be getting overly bullish in a downtrend. On the Russell 2000 weekly chart, you can see very similar story across the board, with the Russell 2000 in a confirmed bear trend with all the moving averages negatively sloping and the price action below all the moving averages as well. Now the Russell 2000 is still at very critical support around 1970, but if we lose that level and take out the low here at 1937, you're more than likely going to see the Russell 2000 trending towards 1700 and possibly even lower. You can see the Bollinger Bands are expanding, giving more downside room for the price action to move. So don't rule out the possibility that the Russell 2000 is trying to make the next leg lower. You can get a lot more bullish in the small caps if the Russell 2000 can start closing back above about 2150, but that's a long ways away, and there's going to be plenty of resistance on the way there. So as you can tell, all of these indices are showing bear trends and bearish price action, so you need to respect the fact that the markets could be trying to go lower, and you really need to pay attention to the bullish breakouts, because that will more than likely give us confirmation that we reached the bottom and we're starting to go back into another bull cycle. You can't just assume we're going into a bull cycle, so you'll need to wait for the bullish price action confirmation. Otherwise, respect the fact that the trends are all lower, and we're more than likely going to see the price action going lower while the trends are bearish. On the VIX, we see more trouble with the bull trend on the VIX weekly chart, and the VIX did close the week above 30, so we're now seeing an elevated VIX, which is more than likely signaling the possibility we could be going into a bear market. When you get a bullish VIX that's closing in the 30s and not getting crushed, that tells you that the fear is more than likely here to stay, at least in the short term, and that does tell you you're likely going to see more downward pressure on the price. So this is going to remain a volatile market until we see the VIX at least getting back down below 24, and we'll be getting a lot more bullish when the VIX can close below 20. But with a weekly bull trend in the VIX and closing in the elevated range of above 30, you need to be very cautious, and it's going to be a very volatile market. And please do remember that volatility does work in both directions. So just because volatility is high and the VIX is above 30 doesn't guarantee that the stock market needs to go lower, and it doesn't guarantee that it's only going to be volatile in the downward direction. You could still get very strong bounces off strong support, and you could still get very impulsive bullish counter trend relief rallies in a bear market. So don't rule out the possibility that you're going to see volatility and whipsaws in both directions, and that will mean that the bulls and the bears will both be getting trapped alike, especially on smaller time frames in intraday trading. On the Bitcoin weekly chart, you can see that Bitcoin is still looking very weak, and Bitcoin's attempt to break out back above the weekly 50 EMA was totally squashed, and the price action is back below all the moving averages, and Bitcoin is still trading below 39,000. Remember, to get bullish on Bitcoin, you need to get a breakout back above the 50 EMA, which means we need a weekly close above about 43,450. If we can get that bullish breakout, we'll still need to take out the high right around 51,000, and then Bitcoin will likely be looking a lot more bullish. Otherwise, it's more than likely trending down to retest this support right around 31,000, and below that, we're more than likely going to see Bitcoin coming all the way back to about $20,000. So respect the fact that Bitcoin is in a bear market looking very weak with a strong downtrend, and it's more than likely not going to get bullish until we can get the confirmation of that bullish breakout. So until we see that, you really shouldn't be getting bullish on Bitcoin. On the ARKK ETF, you can see that we're back down to that very critical support level at $60, and we did close right on top of that level. There is a very real possibility that this is the bottom in the ARKK ETF, but with all the rest of the indices trending lower, there's more than likely still the possibility it's not yet hit a bottom and we're coming all the way down to about $50. You can get a lot more bullish on the ARKK ETF if it can start closing above 91 and 99, and on the way there will be some bullish breakouts like a close back above about 73. But as you can tell, this is very clearly a strong downtrend with strong bearish price action and a very strong weekly bear trend. So don't be getting overly bullish on this ETF, and if it does start closing below 60 early in the week, you're more than likely going to see price action coming down to 50. So jumping back over the S&P 500, this is still a market that's very weak, and there are bear trends and bearish price action across the board in most of the indices and the sectors. We still do have a strong energy sector, but that's not enough to carry the S&P 500 higher, and more than likely that money would be better off in other sectors like technology, industrials, and financials, which would help the S&P 500 reach a bottom and start trending higher. So until we either see a peak in the energy sector or a bottom in the indices, stay cautious and respect the fact that this is a very volatile market, and don't be getting overly bullish in a strong downtrend. If you're having trouble trading this market, it's completely fine to sit in cash and sit on the sidelines and wait till the volatility subsides. There is absolutely nothing wrong with being patient and being disciplined, and most of the best traders know when it's better off to just do nothing at all and just wait until the market gives more clarity. Also, don't forget that I do have Bank Trade Alerts, which is an algorithm-driven trade alert service that only trades the ETF TQQQ and sends all of your buy and sell alerts directly via email and text message. With all of this market volatility in a brand new trading year, now is the best time to be a bank member. You can find out all of the information about Bank Trade Alerts and learn how to subscribe by clicking on the link in the description of the video. I also have the Stocks Channel Discord where I do intraday updates and analysis and bring new trade ideas to you weekly. If you're interested in joining the Stocks Channel Trading Discord community, you can find out how to join the Discord server by clicking on the link below. So thanks for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.